Joining us now is Ajay Srivastava. Good morning. You're joining us on a day when we're seeing green on our screens, but it's volatility which is turning out to be the name of the game. A lot of uncertainty as the globe figures out more about the COVID variant. It's not seeming as bad as one had thought maybe, same time last week, exactly a week ago. Ajay, would love to start this interview by getting your views on how intact you think the bull market run is. After 18 months, the first time we have seen the Nifty, for example, see a 9% correction.
No, I think, good morning. I think the bull market on a longer perspective is still intact for the simple reason that there is more money to be invested than people who want to sell equity. So leave aside the fundamentals of the economy, leave aside everything. The fact remains that there is more money, not only Indian market, global markets sitting for being invested than being divested. And we will see pockets. We will see pockets of exuberance. We will see pockets of fear. We had exuberance in October. We have fear in December. So I think, we will alternate. But the key here is to figure out where the flows are coming from as well. That's where it dictates the market. Today, Indian market is primarily determined and resting on the retail buying at the end of the day. That's what the market is. IPO, institutional buying, secondary market, retail buying. So the FI stocks will languish till the time the FI buying doesn't come. So fundamentals apart, the flows are becoming equally important. And let's come to fundamentals. When you run a long policy of being the low regressive taxation on oil, it eats up consumption. It shows up in the lag. It is now started to show up. Government is reversing policy. And I keep saying electoral uncertainty for ruling parties is very good for markets because they will do what is right now. So if you roll back oil, if you make it more reasonable prices, consumer purchase will come back, economy will come back. If the policy continues the way it was earlier, tax the oil, which is the lowest level for all consumption, you got a problem. Pockets of problems still remain, like what you just saw, the GST on 1,000 rupee garments and shoes was taken up from 5 to 12. Now that's again a regressive policy because it's hitting the consumption at the lowest level. So I think, it's also economic policy more than just flows, which is now impacting India. But hopefully the retail investor public will keep the faith.
The bull market is intact. More than fundamentals, we have to map out the flows, and we have started to see FIs become net sellers. Look at the figures that have been coming in, the rotation that we're seeing from the cash market towards F&O as well as the primary markets. But Ajay, you've also said that there is fear in the month of December. So when there is fear, and as we've been seeing in the cash market, money leaves the market. What are you selling when there is fear setting in?
At this point of time, we're not selling anything. Whatever we wanted to sell, we've sold. We are not in banks at this point of time. We are not in FMCG stocks at this point of time. We are primarily loaded up to the economy-driven stocks, including metals, etc., commodities at this point of time. In spite of the correction, we are buying more of it at this point of time. And whatever we've taken liquidity off the table, we've moved into REITs. And those have done remarkably well, very stable, good returns. Luckily, India has got some REITs which are excellent. So I think the movement has not been out of the market. The movement has been out of pure risk assets in FMCG, banking, etc., into the assets like REITs, which are a little more stable. And I think they've done well. So that's the movement we've done. It's not that we've taken money off the market, but we have certainly shifted it to lots to REITs in the last month or so.
Go and buy REITs. REITs will do well. I'm just breaking it for our viewers here. REITs will do well if the rental yields are going higher. And I think it's easy to assume that work at home is normalizing, demand is coming back, capex has started. More importantly, the rental incomes will start again because IT is building infrastructure, startup economy is coming back. So you need large office spaces, and that's where I think a lot of REITs would start benefiting. So Ajay, there are two REITs which I can think of. One is Embassy, and the second one essentially, I can only think of Embassy actually, Ajay. Which is the other one?
No. You got Brookfield in real estate, but our biggest exposure is to the power grid REIT, both in the private sector at this point of time, IndiGrid, as well as to the power grid. I think that we are more exposed and we have put more money around those REITs rather than the real estate. Real estate, we have got investment in Brookfield, to be honest, because that's, I think, will do well. It's in part of the town and they've done a reasonably good job. But I think the real trigger has come from, and it's done it beautifully, absolutely beautifully, returns are coming out, is the grid, power grid REITs, both the two listed grids, and I think both will do phenomenally well. One has already done well, which is under KKR, IndiGrid, which we hold a lot of exposure to. And the second one is the new one, Power Grid, which listed at 100, is at 120, is given off 6.5 rupees of dividend, still at 120. So, so I think when we look at REITs, let's not just look at the real estate. The power grids of India, the REITs, I think will be much, much better for longer term for the market, because those are two good REITs, rock solid, not fluctuating with the economy, because they get the first money out from every state government and they will keep expanding. So I would say just expand the horizon of REITs from real estate to power grids.
REITs now, with the proposition that sooner than later interest rates will go higher, what kind of return one should expect from REITs? I'm just discussing this with you because normally we don't discuss REITs, but it's an important asset allocation which everybody should look to now.
I think you should reasonably look at somewhere around 10% return. Of course, IndiGrid has given much better return at this point of time. And even Power Grid, if it continues 6 rupees dividend, it should give a much better return, which means 24 rupees, really speaking, on 120 rupee investment. That's the bottom line for the Power Grid REITs. But I think 10 to 12% and about 10% appreciation year on year is going to happen in those assets, because these companies are also going to use leverage. IndiGrid already does, to buy more assets. So you get a leverage spin-off. More important is that the post-tax returns are much better, because what they're doing is, when you get the quarterly money, you get part of the money comes as return of principal. So it's not taxable at the end of the day. So your effective post-tax yield also goes up dramatically. So I would say 10 to 12% and a 10% appreciation. And that's kind of return you should look at post-tax basis.
Bullish on economy, cyclicals. Why are you not bullish on banks? Because you can understand that, okay, if one is bullish on startup economy will not go to banks for working capital requirement or fund requirement. They'll raise it from P investors. But companies who are economy related, sooner or later, they will have to raise capital for capex and for working capital. And banks have delivered. If I look at any bank, any decent bank for the quarter gone by, they were a drop in NPA and uptick in the NIMs.
Drop in NPA, absolutely correct, because you're not lending enough and people are paying it back. At the end of the day, the loan book of the banks is not going up very much. In fact, it's most of the time it is static and is shrinking. And the problem with that market is that when your regulatory environment is so stringent on default that you almost demonize a borrower who can get into trouble, like the Omicron happened, supposing you borrowed money to run a tourist service and suddenly the tourism disappears. Now you'll be in default. The problem is the regulatory system makes it so, bad for the promoter. He can't get out of the country. He could go to jail. Banks have freedom to call you deliberate defaulter, and which locks up all your other things. When you put that environment, a regulatory environment, then risk capital does not come from the bank. Then you go to equity market and say, if I have a risky project, I go there. Then only the AA, AAA who want to borrow, which is packing credit is the biggest exposure they take, which is against export orders and so on. But you really will find people who want to borrow this money and going to set up factories and pledging their personal guarantees. I think that's over. And till the regulatory environment doesn't stabilize, that's one. Number two is competition. 10 years, they never issued a bank license, maybe 2, Kotak and this thing. And therefore, what happened was that they were reaping in the benefits. Today, new bank licensing can come, new banks have opened, NBFCs have become far more aggressive. Fintechs have got equity capital running behind them at this point of time. So they're eating a share of your pie. The technology investment has gone to go up dramatically higher. And therefore, banks are a proposition for them to grow value for shareholders is diminished to a very large extent. So in an economy which is growing at 5-7%, and we are exactly 2 years older in terms of pure GDP, that means the economy has not grown in absolute terms. How will the banks grow? So, for them, growth scenario becomes very, very murky at this point of time. And fintechs will eat their lunch and breakfast. So they got a double whammy coming there and more competition as licenses. you got a triple whammy coming for the banks. And that's why I don't feel banks will give you the return that one they gave in a decade. And that's why the FI selling is more critical, because they are getting away from the sector.
Sure. Ajay, you mentioned that you're shifting money to REITs and you've done that all through the last month. But what else have you been buying? Have you been buying or rather adding positions to any of your existing ones?
I think there have been a lot of corporate transactions which have taken place. So, for instance, we added up, just for disclosure, please don't go buy it, is we picked up Forbes when Advent did a deal with Forbes that they will split the company and so on. So, you go and buy that. You follow up buying with IRB, for instance. If the large investors coming in and buying at 220 and you get a share at 200 or 205, I think it's a good idea to back in. So there is a deal which happened with Sterling Wilson, which of course will be taken over by Reliance. And hopefully, given Reliance plan, they're going to do something dramatic to the company. So you go and back them. So I think there have been specific stories coming out of the system at the end of the day. That's one. And number two, we backed up for a strangely textile sector. For the first time, I've invested in textile sector maybe in 2 decades. So the cotton yarn export sector and the export sector for textiles, that's a sector we have bought into. So sporadic stories, metals, and textile sector, I think the 3 ones we have bought in. And we continue to add on every correction, the liquor industry, because I think if every state follows Delhi's policy, which they'll be forced to follow, I think this is the brightest future for the 2 liquor companies than ever was in this country. So we're buying up at every opportunity in the liquor stocks.
Okay. Ajay, always good to have you on the show. Good speaking with you.